Our next session is looking at real assets. There's been a big move by some of the institutional investors. We hear a lot about buying airports and toll roads, investing in private equity and the like. Is this still an attractive asset class? And if so, is it one that retail investors should look at and can access? So we're going to talk about that in the next session. Dale Holmes from Spire Capital is going to give us a short presentation, and then joining me on a panel to discuss that, we have Rob Talevski from Activus and Tom Schubert from Drummond Capital Partners. If you'd all like to come up and join me on the stage, and I'll hand over to Dale. Thank you.
Thanks, David. Make sure I get this technology right. Is there any secrets? There we go. Working. Thanks so much for the opportunity to be here today. I'll be brief. I'll walk through a few slides and sort of get a bit of juice going in the discussion around the opportunity in real assets. And I've actually broadened it to private assets as well. In the discussions with the team at IMAP, it was considered important to talk about private assets more broadly than just real assets, so also talking about private equity venture and the like. Joined obviously by Tom and Robert and David, so I think that'll be more enlightening for you, but great to be here. It feels a little bit, I was an advisor, showing my age here, I was an advisor back in 1990, Toby, and I remember 1994 very well, so it's sort of feeling a little bit like that. We had a beautiful 30 years of easy money, or easing money, and now we're seeing the sort of movement with interest rates kicking back up. And so that's creating a hot topic for discussion, and that's part of what today's about. We won't have all the solutions. We'll certainly be able to raise some issues, and hopefully there's some solutions discussed as well. At the end of the day, we're all building we're building portfolios for our clients with the view to try and deliver reliable portfolio outcomes around risk return, volatility, correlations, the like. And there's many people in this room who do that well, and I'm not here to tell you how to do it. We basically, we all invest in the same stuff fundamentally across equity, fixed income, real assets. It just depends the degrees of liquidity. On the left-hand side there, obviously, incredibly liquid, daily liquid. To the right-hand side, we're talking about illiquids, and in between, what we're seeing is development in product that is going to enable more people to get access to private markets in more forms of liquidity, semi-liquid product, monthly liquid. And we've started to see that evolution happen here in Australia, Partners Group, Hamilton Lane and the like, and we're about to see an absolute flourish in this space with big groups. We work with Oaktree, Brookfield and others in order to try and build more liquid alternatives for the private wealth space. Blackstone's on their way down to Australia. So once upon a time, what was the domain of institutional investors is going to be on your doorstep pretty soon. So I think that's good news. The poster boy for this conversation has always been the Future Fund, but I think Rob will talk to some others. The right-hand side is really what's relevant for me. I mean, they're related, but effectively, what the Future Fund's saying right now in this environment is we're actually lowering our real return target. We're actually going more broadly diversified, and we're allocating across a spectrum of assets to give us greater diversification by asset class, cross currencies, securities, and the like. So, that's one way of thinking about it. And I think, we'll have clients that we build portfolios for where there's differing degrees of liquidity requirements. Going back to that previous slide, building together the combinations of fixed income, equities or real assets, there's the opportunity to think about how you bundle that together. And every client may have different needs in terms of liquidity buckets. So, obviously a managed accounts built fundamentally around liquidity, but then more and more now we're seeing development in the managed account space where there's the introduction of semi-liquid or illiquid product to complement potentially as a satellite. So, I think there's a great opportunity as we think about the new world, going back to the original slides I presented, is how do we think about building robust portfolios? Every client is trying to get to a future lifestyle. They have liquidity needs, but they also have future liabilities that need to be planned for, and our job as planners is to work with them to achieve those outcomes and deliver them in a reliable way. So part of the challenge right now, and we've seen this before, don't know how long this will go for, but we certainly know there's going to be significantly more volatility as potentially as the Fed in the US raises by another 75 bips, maybe in November and December, and therefore we're looking at a very different interest rate environment to what we've probably experienced in the last decade. So interesting times. In terms of bringing together public and private markets, in a nutshell, they're very complementary. We run private market strategies, so we'll talk our book, but fundamentally I think they're incredibly complementary if they're built together. And the opportunity within the private markets is, what you give up in liquidity, you potentially get the opportunity to build portfolios with, perhaps complementary to your public exposures, whereby you're getting better risk return and correlations than perhaps if it's all in liquid markets. So great opportunity. There's a paper there I referenced to last time I was at IMAP. Blackstone have got a great paper down the bottom there, Patient Capital, Private Opportunity. Talks about the benefits and the challenges of illiquid alternatives. So a good read for those of you that are interested in this space. Here we talk about the trade-offs. Over the history of time, there's a return trade-off. Illiquidity potentially provides the opportunity for heightened returns, but you give up obviously on liquidity. In the space of real assets, to do justice to the real asset discussion and to really fuel discussion, right now, what's the value of having real assets in your portfolio? You can get access to real assets in the listed market. You can get it in the unlisted market. We see the opportunity with real assets playing an important role right now with the inflationary environment. I think what's critical here is to understand cash flows, the underlying cash flows inherent within that real asset, whether it be a piece of infrastructure, real estate, whether it's in the space of, commodities and the like. We want to understand what the future cash flows are like. For those assets that have effectively fixed indexed returns, which may not keep up with inflation, act like a long-term bond, potentially you're going to see loss of value. For those assets that are able to be indexed to inflation, that have built-in indexation to inflation, or have the ability to move cash flows in a very short duration sense, then there's great opportunities to drive cash flows with inflation and have that real asset backing. There's always an inherent value in real assets. We've probably all experienced the virtue of having, exposure to real estate over the last 30 years. Rising interest rate environments changes the complexion of that. But ultimately, if you've got great cash flow to carry the day, to get you through the challenging times, then you can actually endure some volatility in that capital value. But real assets do give you inherent value. What we see is not all real assets are the same because of these cash flows. So getting down and doing the due diligence on the discounted cash flow models and understanding the real cash flows inherent within an asset is really critical right now, more so than ever in a rising interest rate environment. And obviously across real estate infrastructure, commodities or resources, there's a range of things to consider. I'm not going to go through all those today, but we can have a discussion about that in terms of real assets. But I do see the virtue right now of having really strong cash flows that are indexed to inflation to protect you against loss of value in your real asset exposures. And correlations is an interesting discussion. This is a big debate around the unlisted market versus the listed market. It gets plenty of publicity every day. Suffice to say, if we went back to that earlier slide, which talks about the very liquid end of the market, as soon as you take a real asset exposure or a private asset exposure, or a private equity exposure into the listed market, it's going to behave obviously far more like a listed security. Whether that's a good or bad thing, everyone will have their view. Anything that gives you the chance to build some diversification across the asset classes, across public and private, and manage volatility within your portfolio, I think right now that diversification is absolutely essential. And in terms of inflation hedge, we see real assets deliver some hedge against inflation, but again, I would warn, not always. You got to get down and dirty on the underlying cash flows inherent within that real asset exposure. So last thing, this is a great example. I'll just use a practical example. This is an example that we've been exposed to. The orange line here, this is the same asset class. It's US residential housing in the for rent apartment communities, $5 trillion sector. But what was interesting, if you look at that blue line, back when COVID hit, we saw a 45% drawdown, which was all driven by sentiment. Fundamentals were, nothing changed. And so the private market continued on. Public markets drew down 45%. Clients had to experience that anxiety associated with that volatility. Fundamentally, in terms of supply, demand, there was no changes going on in that market. In fact, occupancy went up as people were looking for affordable rental. Point I make here is same thing happened back through that GFC. We see this blue line have high vol. Now, the debate that goes on in public versus private is, does private actually value appropriately? Question is whether real estate should be valued every day. In the listed market, you get the volatility associated with that. But this is the opportunity that presents itself, is for us to be able to complement our public exposures with our private exposures. That is my, I've just gone one too far there, but that's an overview of the considerations around private assets and real assets in portfolio construction at a time of rising interest rates and rising inflation. So that's, I'll hand back to you, David, and I think we're going to have a panel discussion and some Q&A.
Thanks, Dale.
Okay.
Has the attraction of particularly the real assets, but even things like private equity and so on, been because of the cash that's available, the low rates and the money sloshing around, being attracted to higher rates, detract from this asset class potentially now? I don't know who would like to go first.
Yeah, Rob? I think people have heard enough from me, so you fire away.
Look, I think, we're all fairly familiar with the fact that some of the asset classes, like infrastructure in particular, has done well in the last 12 months, but also the last few years. I mean, it was doing well when markets were rallying, and obviously it's done a lot better relative to markets as markets have been trending down. And obviously certain assets within that infrastructure asset class do well. Certain types of assets that, essentially that inflation effect does get passed on to the ultimate consumer, which has very little choice but to pay it. So from a revenue standpoint, infrastructure has done very well. I've obviously listed, probably unlisted more so than listed, in the sense that obviously that issue with valuations and that sort of much more smoother kind of, performance, I guess, trending. Also, private equity as well, done well as well relative to listed. And obviously, again, that question around valuations. And what I find is, in particular during these times, and you compare it to listed markets, where with private equity, you've got three ways of making money, essentially. You buy well, you don't overpay for a certain private equity investment. You build well, i.e. when you own the asset, you improve it, you bring in your own management, cost structures, revenue, opportunity, and then you sell well, obviously, around that sort of IPO or sector buy. Now, the buy well and the sell well, some of the listed managers here probably say, yeah, we can do that as well. But the real value is in that sort of build well part of that sort of transaction. And really good private equity managers can, add a lot of alpha during that sort of period of time. So in my view, I think, real assets, infrastructure and private markets have done, should do well over periods like this.
Thanks, David. Yeah, I mean, it's more for us a consideration around the new paradigm of a higher yield curve and the pace of change, I guess, in rates, and how quickly that's been reflected in sort of public market assets versus private market assets. We've seen the extreme damage done to the really speculative areas of listed tech in the US, and only 6 or 9 months later starting to be reflected in lower VC valuations. Obviously listed property, listed infrastructure down a lot more, I guess, than what we're seeing in the private markets. And so it's more, if you are interested in the unlisted assets at the moment, I think it would be making sure that you understand the cap rate or the valuation methodology that's applied to those assets, and that it actually reflects, the new outlook for rates, as the public markets are certainly starting to do.
And David, I think to the question you asked, the fuel that's been given to asset prices over the last 10 years and accelerated through what the Federal Reserve and central banks had to do as a result of COVID is, we saw incredible asset price inflation as a result of abnormal interest rates. And now what we're seeing is the normalisation of that, and hence what we're seeing is gravity play its role, and asset prices are starting to be impacted as a result, regardless of whether it's listed or unlisted. And Tom's right, that it's measured every day in the listed market, and clients get to see it every day. Not so in the private markets, and people can debate the good, bad or ugly of that, but essentially that's real. And so it's a free lunch for some people to build, less volatile portfolios by having private-public exposures. But the other thing is that I think the point I made earlier on is cash flows is everything here. Because, there's different types of real estate and different types of infrastructure. And if you can't move the needle on cash flows, if you can't keep in pace with inflation, then you've effectively got if you've got a bond proxy by way of a form of infrastructure or real estate, then your asset value is going to get hurt. So I think you do have to find ways to build well or develop the cash flows. And so, having very, very strong operational strength through this time is going to be really important.
And Dale, you mentioned in your presentation the Future Fund, and that's obviously one that's often put forward as an example, and perhaps an extreme one in terms of not needing to worry about liquidity and so on. But they've gone all out on things like private equity, hedge funds, etc. I know other example is Aussie Super. Just not just buying shares in Sydney Airport, but taking out the whole airport, for instance. And Rob, you had some views, I know, on whether that's a suitable thing for retail investors, and perhaps you want to talk about the differences between those sort of funds and the retail space.
Yeah, look, so I mean, my sort of previous role was working with a lot of the larger institutional super funds, the Aussie Supers, the Rest, the Cares, the Rios, these sort of industry funds where, they were investing in a lot of direct assets in that infrastructure space, the private equity space and property space. So for them, they saw the benefits. It probably started in the early 2000s, and they've been consistently investing in and re-ing up into these sort of private equity. And you're right, I mean, Future Fund's probably a totally different scenario in terms of what they're looking for, returns and what their time frame is versus sort of Aussie Super and the rest. But the opportunities are there. I think if they're done correctly, from my point of view, we've been very supportive of investing in the private equities, the infrastructures. Obviously listed, if I had a choice, I probably would invest in an unlisted vehicle as well as property. So look, from that, there is an opportunity, I think, for us now to kind of really gain access to some of those investments that, only, I guess, up until now, industry funds really saw that as they were sort of able to kind of differentiate themselves from the retail investors and say, look, what we can do where you can't do it. And, we're seeing a pretty good trend coming to it, much more access, but I think there's definitely, more sort of opportunity to explore.
Yeah, all good points. I'd say, illiquidity is not a substitute for quality. The Australian super buying an irreplaceable monopoly asset in Sydney Airport doesn't mean an SMSF should go and buy a single office property trust in there privately. And so you need to understand that I think some of the best quality assets in the world are listed, and if you are buying office, the best offices in Australia are listed, and they're accessed, through traditional, whether it's an ETF or an active manager. And I think so if you're going to take the illiquidity risk premium, I think you need to understand and have think about the thematics that's driving you to lock up your capital for an extended period of time, 7 or 10 years, and gaining access potentially to sub-asset classes, whether that's in the renewable space or commodity space, that aren't so easily accessible on the public markets at this point in time, but also have a really strong underpinning from a thematic perspective over time that hopefully means less chance of you getting in trouble.
And I'll just add one thing to that, and that is that the planning process that we all know is working with our clients to work out what liquidity needs they have, to work out, what future liabilities they need to match up against. And sometimes that presents occasions where you can work with your client to understand, effectively a bucket approach to investing where you might have 7 years of liquidity in the portfolio across cash and then equities and then ultimately for the sort of longer dated stuff, you're prepared to lock it away to really try and find that illiquidity premium. That might be, in the private equity space, it might be unlisted private equity or venture or long dated, unlisted infrastructure and the like. So what's interesting is we're starting to see the big end of town in the private markets recognise the value of private wealth. I think I said last time I was here that Blackstone sees 50% of their future flows coming from private wealth, which is amazing for Blackstone to say that, be public about it. So, I think what that means is those groups are going to be in market with their monthly liquid strategies, and there's a lot to be done on the diligence side to understand how liquidity works in that environment as well. So, but it certainly gives you some tools as a planner to work out your liquidity buckets and how you want to match that up with clients.
And I guess that, Dale, gets us into the sort of practical side, if you like. And I know, Tom, you're running managed accounts. I mean, how easy is it to do these sort of strategies in a managed account, or how do you approach these sort of illiquid assets and the like in that environment?
Yeah, I guess we're sort of trying to reimagine core satellite with our clients now, where the core is a well-diversified risk profile-based managed account, talking our own book, of course, and we get great exposure to real assets through listed infrastructure and real estate. But we're seeing, as you mentioned, increasing demand. Our client base tends to be predominantly high net worth advice businesses wanting, that high net worth investor wants access to private equity, venture capital on the growth side and on the income side through private debt and unlisted real assets. And so I think rather than trying to bastardise the liquid managed account that we need to actively manage, we see it as an opportunity to create satellites around that as a core. Through researching, doing the due diligence, it is more complex. Advisors definitely need help in this space and bringing sort of best ideas to complement that kind of core liquid managed account. But back to my earlier point, we're looking for particular asset sectors or themes that we're not necessarily getting exposure to through our traditional public market exposure.
And Rob, I know you've got a slide that we've put up here for you that you'd like to talk about?
Yeah, sure. Just a point. In terms of, I guess, the due diligence side of things as well, it's very, very different when you're assessing a private markets investment vehicle or opportunity. And a lot of it is, your DD is front-loaded. Obviously, you've got to do all the work before entry, not like, in a listed vehicle. Obviously, you've got an exit, fairly easy. But with these private vehicles and infrastructure, property, unlisted, you're in there for the long haul. So you kind of want to make sure that, you select, the right type of manager or vehicle. And the other one is, the DD, like I remember a couple of stories where some of the private equity managers, the due diligence people on the private equity managers, they hired investigators to actually make sure that, there was nothing that would sort of not come out obviously during our DD process, but even sort of some of the lengths that sort of some groups were going to kind of make sure that, the private equity manager sort of, was good enough to investing as well. And it's more deep diving as well. Obviously at the deal level, you're going to make sure each deal that they've invested in, they've added value, not just beta essentially. So it is quite different. In terms of, I guess, what I've got here is just, I guess, a sample of some of my old clients that I used to be a consultant with, but nevertheless, I think this is kind of just a picture to kind of compare what some of the industry funds are allocating to in terms of, obviously, private equity on the left there. So kind of a range there of, 7 to 10%. I think Future Fund from memory was 20, something like that. I think they've been cutting back a little bit lately. Property around that set of 7 to 9%. Again, that hasn't changed. Like, when I was doing this 10 years ago, it was pretty much the same. And then infrastructure, 8 to 10%, which has sort of stayed constant, if you like. Now, the bottom is the median. That's the average super fund. Obviously, these are the more kind of active funds on the top there. So I guess sort of what am I saying there? I'm just saying that, essentially what you're finding is that, the select few of much larger super funds have not only sort of been pioneers in that sort of sector, but they've also maintained that exposure to private markets. So from that sort of point of view, it really kind of gives you a sense of, where the trend is going. And again, that's sort of more and more now moving into our sort of the retail space.
Now, if I'm an advisor and I want to put my clients into Aussie equities, there's the Morningstars, the Lonsecs, the et cetera, putting out the ratings. I can easily look up and see who gets 5 stars or whatever it might be. How do we approach that in this space? Who, if anyone, is rating private equity funds or infrastructure, or how do we get the information?
So in the private space, there's certain sources of market intelligence that you can get access to. So that's a starting point. But there's certainly, to Rob's point, enormous amount of due diligence that's got to go in at the front end to make an investment in something that's illiquid, because you don't have the optionality to then sell out. So it requires, there's certain researchers who specialise in the space. I mean, for example, we will liaise with large global asset consultants when we're looking at a deal. We want to understand the views of other asset consultants as a feeder and filter into our process. So yeah, I think there's certain sources of market intelligence that you can get access to, a bit like what you can get in the listed market, but it's far more complex.
So you need a good asset consultant, I think, is what you said again.
That's right. I should have said that. I apologise.
Reading between the lines. But I think for me, sort of from experience, it was 2006, again, working with even the larger super funds, who to this day, obviously, they're well and truly, very sort of supportive of these asset classes. And, we had these discussions, the Host Pluses, the Aussie Super, and, for the first time we presented to them, this was a venture capital fund, this is an asset, and they sort of turned around and go, get out. Like, everyone's had really bad experiences at that time. And, it was an education process, and it took us probably 4 to 5 years, getting in front of investment committees and boards and just getting told, come back in a few years' time. But over time, they really kind of started understanding it more, and they started getting, toe in the water, putting 1%, 2%. And then, now obviously they're well and truly sort of there. And, some of the, I won't name names of one of those super funds that, was the biggest haters of, private markets, are now considered the pioneers of venture capital. But again, if they can sort of, change with a bit of education, I think anything's possible.
Probably another thing that's going on, just as it's an interesting sort of part of the ecosystem, is because the amount of money that's flowing into the private space now, we're seeing a lot of take privates. So we're seeing the universe of investable opportunities in the listed market start to shrink. Private markets starting to grow. I'll be controversial here. I actually love investing in businesses where the owner and the operator of the business is hands-on, sits around that business, knows it intimately, understands the competitive universe, can drive value through that business. I'm less inclined to want to invest in a business that has 8 independent directors who have no skin in the game, effectively debating about the virtue of something that really I don't think they can control or even influence. So that's part of the discussion around private-public and why it makes sense to have allocations in private markets. I'll back businesses in this room over the National Australia Bank every day of the week because of that, because they understand the business, they understand the margins, they control it. It's run by people who are intimately understanding the sector, understand the business opportunity.
Might just be worth teasing out some of the upfront due diligence requirements in a little bit more detail. I think it is a really important part of doing your due diligence in this space, particularly around the operational due diligence, the ODD components, and there are specialist providers that can do that. If you're investing in a large offshore manager and you're not able to actually physically visit the site or the HQ for whatever reason, I think particularly in this space, it's not good enough just to meet the portfolio managers or the team and read you need specialist legal due diligence on the documents, because often the documentation can be complex, and you need specialist operational due diligence consultants to help make sure that the assets are they say they are, and that the operational support is sitting there behind the portfolio management team to actually deliver on the investment strategy.
And I think, as much as you can be around the table for the ongoing sort of governance of what's going on. So, sitting on limited partner advisory committees, so you're actually able to be close to the action and call the bullshit if you're seeing it. So, yep.
Dale, you mentioned Blackstone talking about 50% of their money coming from private clients eventually and so on. And, we've heard about clients coming in and saying, well, I see Host Plus has got 10% in private equity or future funds doing this. And so there seems to be an expectation it's going to happen and clients are interested. So why are we not seeing more of the retail client in that space? Is it because the advisors don't quite understand it, or is it because it's difficult to do the due diligence?
Well, I think, through the course of time, there's obviously been situations where, to Tom's point, quality has been not there. And so, as part of this process, obviously regulators want to protect retail investors, and so therefore they're putting barriers to entry for retail investors to get access to private investments where it is more complex. And that's the right thing to do. But at the same time, there is a quality into that private market. And I think, in the US, there's moves to sort of try and make access more available. So I think there's a movement towards as we're seeing the investable universe in private markets grow, there's a movement towards trying to make that more accessible. The issues around liquidity have always been an impediment to long-dated private markets. So we're seeing more, sort of monthly liquid solutions come into the market. And first movers on that, we talked about before, Partners Group, Hamilton Lane and others, we'll see a lot more of that coming down in the next 12 months.
Just a point as well around, access. And I mean, to your point, Dale, there's been a lot of capital, dry powder in the private equity circles that's been raised over the years, and that's really looking for a home, and there just doesn't seem to be enough deal flow at the moment. So, I mean, that's a real issue. That obviously means it's sort of potentially, going to inflate assets. And the other thing is, again, I was fortunate enough to do some travel overseas and sort of San Francisco and all that sort of VC stuff. And, it's almost like impossible to get into the best stuff that was available. So, in essence, to your point, why isn't it available? Well, they don't need our money. The problem is they unfortunately, they're so popular and there's so much capital chasing that the best ideas that it's really, really difficult to get into.
So the more retail engineering and product development that is put on any asset class, the more and more it looks like a public market alternative and with a much higher fee load. And so, unfortunately, that's just the nature of the beast. If you do want to invest in these assets, I think you need to be able to, be prepared to accept the characteristics of some of them, whether that is illiquidity. You need to be prepared to lock up, otherwise you're going to get unfavourable terms and probably should stick to your knitting in public markets. I think it's
absolutely right. And I think the amount of money that was going into the sector, leading up to the recent correction, effectively meant that you did get incredibly frothy valuation going on in the sort of large cap end of the market, mid cap end of the market. So, it's normal due diligence. It's just like in the listed market, you're looking at sort of, valuation as well as quality. So they're the important due diligence criteria, whether it's public or private.
Now, I mean, we've talked obviously a lot about the time horizon, the lack of liquidity. You've got to lock up funds for potentially a decade or so in some of these opportunities. Given the way we've seen markets move in the last 6 to 12 months, and there's been very big swings in equities, in bonds, in short periods of time, I mean, is there a risk that if you're locking up bigger portions of your funds, like the future funds of the world are doing, that you might miss opportunities that are happening in some of the more liquid markets at the moment?
Yeah, there's definitely going to be arbitrage, we sort of spoke about earlier, between listed and unlisted. And this comes down, and particularly in venture capital and private equity, to the question on vintage and understanding, what sort of returns you're likely to experience based on the starting valuation today. I mean, if you look at SaaS businesses, the vintage in VC last year was like 20 times sales, which is just extraordinary. And already you're seeing, indexes of the similar companies down to sort of 6 times. So if you were a VC, a SaaS investor last year, you're going to have 10 years of no return. But if you're arguably going to invest in that space over the next 12 months, you're probably likely to do very, very well. So understanding where you are in that cycle before you make such a long-term commitment, I think is really important.
Yeah, and I think picking the right managers that are disciplined in their valuation approach and will have dry powder to look at opportunistic buying rather than just allocating capital all the time. That's part of the challenge, is to find the groups that are disciplined in their valuation methodology. And so even with working with your clients, you know, Future Fund always talk about the fact that cash is an offensive play. Cash is not just a defensive play. It's actually having cash available to make investment decisions at the time when everyone else is quite fearful. And so I think, you know, that's part of helping clients work out what their liquidity buckets are, how much they can allocate, and how much they can sit on the sidelines with.
Yeah, I find, you know, in extreme events like currently now in 2020 and 2009, you're reading the papers, you know, about the certain super funds that are having issues with liquidity and matching sort of liabilities and so on. So it is one of those, you hear more about it in events like this. And you know, to Tom's point, yes, I mean, obviously, if they're going to have to sell their private equity, there's only one way to sell it, and that's on secondary markets. And to do that, they're going to have to give up a 20% discount to NAV and plenty of uplift that's probably in the actual asset itself. So, you know, if you're too exposed, yeah, absolutely, as a fund, you'll be selling at the wrong time.
Now, our next session is on ESG, and we don't want to cover too much of what will be covered in that session, but we're certainly hearing that ESG is becoming a bigger issue generally for clients. They're more interested in what their money is doing and where it's going. How tricky is that in this space, in things like private equity, venture capital, even the real assets, in meeting clients' ESG requirements?
In some ways, it's probably a good way of getting the specific exposure that they're looking for. We're seeing a lot more, you know, single assets or single asset, sub-asset classes that maybe are in the renewable energy space or impact investing. And so if you're wanting to target a specific outcome, then actually the private space is a really great way to do that. Obviously, as soon as you buy a large public market fund, you're diversifying away and you're getting some with the good or some with the bad. So it is a good way to get exposure to that, but it is more niche.
I think it's becoming a non-negotiable. Like, the institutional market are very big on this, and rightly so. You know, I think managers see their ESG focus and their execution as good business and part of their ability to win capital globally across the spectrum. I think, you know, that's a good thing, and I think it means good. I think they're not mutually exclusive. I mean, we invest in a global infrastructure manager that at their core is focused on, you know, the whole space of social infrastructure and renewable infrastructure and doing great things in the space, but they target, you know, some seriously high returns. So this sort of misnomer that you have to give up on returns in order to be able to get some sort of ESG focus I think that's right. And I think the good managers just see it as part of their business process.
I'm actually seeing some interesting sort of private opportunities in that sort of ethical space. And don't get me wrong, you're going to have that in that listed space as well. But, you know, I'm finding more the private capital is chasing sort of the slightly more higher quality deals, which sort of not discourages them, but it sort of makes them think, well, what's the point of going on the listed market when I'm getting all this capital on the private side, you know, easy, so it's easy to keep it private. But yeah, again, absolutely opportunities on both sides.
Look, we're going to have time soon for some questions from the audience, but before we open it up, maybe I'll ask the first one if I can, and I'll leave Dale out of this, but perhaps Rob and Tom, just where do you see this space at the moment in terms of what you're telling clients or what you're doing with your portfolios? Are you like the Future Fund? Are you overweight alternatives, or is it something that you're cutting back exposure to?
We've carried liquid alternatives in our managed accounts now for a couple of years as, you know, positive real return diversifiers with, you know, absent returns from government bonds. But the relative return between government bonds and those assets now is probably looking more attractive. So on the listed side, we're certainly tilting back. In terms of the unlisted side, we are, you know, rolling out as I said, a sort of private market opportunities research service for our investors and our clients, and they And we're really trying to target very specific assets that we can't get exposure to within managed accounts and run that as a complement to the core liquid outcome. We're seeing a lot of demand. I'll be interested to see, I mean, a lot of that demand was driven from last year. Everyone wanted exposure to this stuff. We've now rolled out the service and our first products that we've rated in this space, and we'll see how much actually gets invested now that the cool breeze is blowing over markets.
For us, since Activus was sort of inception, I guess, 2016, we've had a constant position in Partners Group, private equity, so it's been around sort of 8%, probably one of our best calls that we've made relative to listed, particularly the last sort of couple of years. Infrastructure's probably the other best call we've had in terms of, I guess, having a very kind of large allocation to listed, but again, relative to market. So I guess, for us, we're very big supporters of the asset classes, and if you do it right, obviously there's, just like any in listed space, you've got to pick, the right sort of investment, but we're very big supporters. Our performance is done well as a result, and I think we'll continue to support those asset classes.
And Dale, I'm sure you're overweight the sector, and everyone should be buying, right?
Well, we have a vested interest. We build product for that market, so best leave me out of that one, David.
Okay, look, it's a very broad sector. We've touched on it from a sort of big picture portfolio point of view, but we'll now open up and please, any questions? We've got one from the back there, yeah.
Yeah, hi, I had a question about how do you reconcile investment strategies which are longer term versus APRA reporting, which is more shorter term, so 3-month quarterly reporting, and for listed versus unlisted?
Sorry, the question was how do we reconcile long and short-term timeframe investments? Is that right?
Yeah, that's correct. So, if you have unlisted investments, it would be more longer term, so you wouldn't be able to value them, every 3 months. And, a lot of APRA reporting is quarterly reporting. So, how does that work?
You can go first.
All our APRA regulated superannuation product is all liquid. And I think the point of what we're trying to talk about here is not mismatching between the two. So that, if it's APRA regulated, it's liquid. That sits on a platform that works nicely. What we're talking about is more sort of satellite long-term and potentially not under APRA guidelines from an individual investor's perspective.
I think that's probably the key point, isn't it? No APRA reporting in managed accounts. So you don't have that. You don't have that problem.
Yeah, but you'd have quarterly reporting within a private market environment where there's a methodology for reporting, and everyone will have their view about whether the valuations are tight or not. But ultimately there is effective discounted cash flow models built around sort of discount rates and the like. So effectively that happens, and then it's opined on once a year and signed off on, typically with third parties. So.
Yeah, I mean, I guess, SPS 530 is a regulation around super funds and stress testing, scenario analysis, forecast modelling, etc. And we sort of, I guess we do something similar in the sense in our portfolios, we do the stress testing, we make sure obviously, and there's a liquidity test with that. So, you want to make sure you're not overexposed to those illiquid assets for obviously that reason. So it's just, portfolio management, I guess, asset class 101, making sure you're not overexposed and understanding the effects of, worst case scenario, if markets are down 40% and, you've got 5% in unlisteds, you can get out of it. But if you've got 20, well, that's going to be a problem.
Any more questions?
I've got a question about, now as rates rise, we've heard several times through today, people talking about markets have been awash with cash. That situation may not continue in a rising rate environment or a higher rate environment. Do you think that issue of less available cash will impact this market in particular?
Yeah, definitely. I think you take cash out of the system, it means that there's less people at the table to buy your asset. I think, one of the things that we had in a low interest rate environment is people were investing for yield, and maybe we bought assets that, were income focused and passive, and all of a sudden inflation and interest rates kick up, and, you're exposed because you're effectively, your terminal value on that asset might be impacted. So I think going back to the conversation around how do you drive value, quality is critical and cash flow is everything. So I think right now, if you don't have the ability to move the needle on operations and cash flow, then you're exposed.
I guess maybe drawing to experience back in 2004, just post the tech sort of bubble burst and then all this extra capital coming into private markets, I think I sense that there's going to be a bit of a bloodbath. There's going to be some managers out there, just like we're seeing in the listed space. There's fewer, left, I suppose, for various reasons. But I mean, don't get me wrong, the private space isn't, going to get out of it either. And there's a lot of money, there's a lot of funds that have raised, a ton of money. And unfortunately, there's some managers that are just going to fold or blow up or whatever. So, it's not just listed equities, it's also private markets.
I think Tom covered that well around the VC space. Go back 12 months and sort of ridiculous valuations being paid. And that's now, we see much more sober valuations today.
Liquidity withdrawal, credit supply is contracting at a rapid clip, like an incredibly rapid clip. It's going to affect everything, and it's just that these assets are taking longer to catch up to the public market reality of where we sit today.
We've probably got time for one more question, if anyone has one.
Hi there. Just quickly talking about liquid, illiquid. As an advisor, we only have access to certain research materials that we can rely upon to give to our clients, right, when we're presenting our recommendations. What are some of the key, points in terms of what type of property infrastructure, private equity fund that you would use that is suitable for your client?
For the retail space, you'll find, I think, that the groups that are coming in, the product issuers that are coming in to the space will be doing publicly available research, the Zenith Lonsec of the world. So that's becoming better researched in the alternative space, private market space. Obviously, there's the issue around wholesale versus retail. But effectively, I think you'll find there'll be more coverage of the sector. And I think that's already emerging. And then there'll be asset consultants like Rob and Tom.
Yeah, I mean, that's exactly, you can sort of look at, at the research from, the bigger research parties. But I find that, a good asset consultant, if you like, will do their own DD on top of that as well. But it's also communication. Like we find at the beginning, it was like, what's this partners group thing, 6 years ago? And again, it's the education, it's the sitting down going, okay, well, this is what, private equity does. This is what infrastructure does to your portfolio. These are the benefits. This is the track record, the proven, all that sort of stuff. And again, we have a role to play, I think, in sitting down with you and your clients and giving you that collateral to help you with that sort of story to your clients.
Okay. I think we'll end it there. We're pretty much on time. Just please join me in thanking Dale, Rob and Tom for a very interesting conversation.